Wednesday afternoon. My name is Travis Cabin. I'll be your host for this webinar today. And to go through the webinar today, we're probably looking at about 45 minutes to get through it. And if you'd like to ask me questions, unfortunately you can't do that live over the phone just because we've got too many people on the webinar this afternoon. But you can connect with me and ask me a question either through the webinar or right at the tail end. And if you look at the right-hand side of your screen, you'll see a box there where you can actually type me questions. And at the end of the presentation, I'll actually go through and answer just as many questions as I can. And the ones that I can't get through, just out of respect for everybody's time, I'll actually send you an email from our Investor Relations Department. We'll send you an email. We'll answer any questions that do come in. So that's how you can communicate with me and the Arizona Investar team with any questions that you have on this presentation. And of course, at the end, we'll give you our email address and phone number so you can follow up if you have any further questions or you'd just like to get more information or proceed with investing in Arizona real estate. Arizona Investar is a Canadian-based company. We have an office in Calgary as well as Phoenix, Arizona. And Arizona Investar provides turnkey real estate investment opportunities to Canadian investors. And of course, you know, with the economic times what they are, we've got more and more people looking at real estate as a form of investment versus, say, their traditional stocks, bonds, and mutual funds. And what I'd like to do today with this webinar is I'd actually like to walk you through so you can actually see firsthand exactly how you can make money both from the cash flow perspective, appreciation. We'll talk about a couple other creative structures as well and strategies that will work for you in the real estate realm. So why don't we get started with the webinar? And again, thank you for joining us this afternoon. The first thing is I think it's important to understand who is Arizona Investar and who is the turnkey real estate team. Arizona Investar founders have been in the real estate industry for about the last 28 years. So many years in the real estate industry, saw lots of peaks and valleys, different economic situations, and it's comprised of individuals that are professionals in the real estate space. It starts off with our market research and analysis, and so we have a little team that's put together to oversee that and really kind of find what are the best opportunistic markets to invest in. And you know how we've always said that live where you want to live, but invest where the numbers make sense. And you can really place capital in various real estate opportunities, and it doesn't have to be in your backyard. And in a lot of cases, it's probably best if it wasn't in your backyard. The next section would be property selection. We have a team that's dedicated to evaluating what is the best properties to acquire in the selected market. And so they do a great job as far as telling us what exactly that is, whether it's single-family homes, duplexes, fourplexes, multifamily, commercial, raw land, service lots, and we have a team that's dedicated to give us the best opportunities in the market we've selected. Once you buy a property, whether it be a single-family home or a multi-project, of course you need somebody to do the renovations. So we have a renovation contractor that we work with that's does a great job for us. When you're a Canadian and you're investing outside of Canada, it's very important you've got a cross-border tax specialist that works with you before you buy the property, and that's the key thing, before you buy the property, to make sure that you buy it in the right identity. You know, we see lots of Canadians making mistakes where they're going into specifically the U.S. right now because it's just an unprecedented opportunity there right now, and they're actually making a mistake in the way that they buy their property, and it's going to come back and kick them in the butt when it comes tax time because they're going to, in some cases, pay more than double tax. And it's easy to avoid. You just have the proper consultation beforehand, and Arizona Investar has a specialist that deals with cross-border tax items, and they can consult you on your own individual basis because everybody's different. Some people already own property in the U.S. and some people don't, and they kind of walk them through that just to make sure they get the right structure that's best for them for who they are today and what their objectives are. Canada-U.S. mortgage lenders, of course, when we do use leverage, and we recommend using leverage, we call that other people's money, when the bank is willing to lend you money on your real estate investments, and of course that's one of the beauties of real estate is the banks love to give you money so you can buy it. A little bit different than, say, a stock, bond, or a mutual fund, I guess. So mortgage lenders, they like to lend money, and in fact you can get money from our U.S. lenders right now, and we have a specialist on our team that specializes in getting Canadians financing and specializes in U.S. financing. Next thing, of course, is once you have a great property and you got a cash flowing asset, you need somebody to manage that for you. So we've got a great property management individual on our team, and they oversee all of our property management for our investors. And again, that's an optional item. If somebody would like to manage a property on themselves, or they just like to buy one of our great properties and have somebody else manage it for them, well, they can do that too. It's an optional service program that they can take on. So property management. And of course, we have recommended insurance companies, foreign exchange companies that you can work with as well to make sure you get the proper insurance coverage for your property, as well as making sure that when you do exchange your money into a foreign country or a foreign currency, that you have the proper consultant to see you through that. And these are just options for you to choose from. And if you would like to use your own banker, in this case for foreign currency, you're more than welcome to do that. But we do have our recommended choice based on our years and the millions of dollars we've transferred into foreign currency, specifically U.S. And last but not least, of course, is our investor reporting. Once you buy one of our turnkey properties and it's under management, we just don't leave it there. We actually communicate with you and provide you updated market statistics and bring you just up to speed on exactly what's happening in the marketplace and making sure that you're pleased with your investment. With regards to the corporate structure for Arizona Investar, the principals, like I said, have been in the industry for about 28 years in the real estate investment industry. We have offices that are located in Calgary as well as Phoenix, Arizona. And funds under management, right now we've got about $25 million that's currently under management right now that's been we're managing for our investors across Canada. And on the property portfolio management side, our guys got about 1,500 homes under management there right now. And on our portfolio, they're running a 2.75% vacancy rate. So they're doing a real good job there. And property management is the key, and making sure you got that cash flow coming in every month, and having solid property management is the second leg of the key ingredient to make sure that you've got steady cash flow. Real estate investments can provide a number of things for our investors. The first thing is additional income. Well-bought and well-timed real estate purchases can give you additional income. And what I mean by that is I mean that you have net cash flow after your income and your expenses. You got a few extra dollars there left over, so it can provide some additional income for you on a monthly basis. A lot of investors are looking for additional retirement income or capital growth. And of course, right now, with the way that the stocks, bonds, and mutual funds markets have performed over the past 20 years, it's caused lots of havoc for our retirees right now, where they're saying, listen, I don't have enough money to live the rest of my life, like my financial planner said I would. And maybe you picked the wrong financial planner, or maybe there's just some fundamental flaws with the way that the system has been run. That's up for debate. But real estate will provide you some funds for retirement, both for cash flow and equity growth, so you can increase your balance sheet there and have something in your kitty for your heirs. Savings for children's education. We see younger people buying real estate to provide that platform for cash flow and equity growth for education and things that they want to do in the future and achieve some of their family goals. And the state for the heirs, of course, real estate has always been a big thing when somebody passes on and you're evaluating their estates. A lot of that wealth is made up through real estate. And then last but not least, of course, is overall financial freedom. Give you a little bit of stability at night when you go to bed, knowing that you've got some good cash flowing assets in great appreciation markets. I think that's a good thing. The retiring population today, when we talk about what are they doing, where's their headspace at, and what's happening, and I know that a lot of our investors are approaching retirement or they're in retirement, and it's really common for us to hear them say, only if I could turn the clock back, I would invest more in real estate. Because at the end of the day, they know that the bulk of their net worth is in their real estate, and for a lot of people, it's in their own home. I think a lot of the investors today, they're confused because they feel that maybe the banks really haven't treated them the way that they should, and of course the banks are making money from your money, and the investor's not making much. If you look at the stocks, well, I think that's really driven by emotions, and most of the money that's made in stocks is before the stock is even made available to the retail investors, because the bulk of the money is made at the IPO stage, where they get in at the early discounted value, where they're the privileged investors, as they're called, to get in at the IPO stage, and they actually sell to you, being the retail investor, and then you just play off the emotional swings and maybe a little bit of cash flow that's stripped out of it. And I think the mutual fund industry, that's just simply history tells us that that's struggling at best to deliver on expectations that are laid down. So we see more and more of the retiring population today that are looking at real estate not only as a form of cash flow, but as a form of capital growth and appreciation, and a little bit assistance to build up their balance sheet as well. Types of real estate property investments that we focus on is single-family homes. So these single-family residences, condominiums, townhomes, and as well multiple units. That'd be multiple units as far as multiple family units, and it could be 1 to 4 units, and it could be more. The goal, our objective here, is to put your money to work for you in more ways than one. And really what we try to do with our investors is we try to get them to invest, obviously they're going to be using their savings, and whatever they can strip off of their biweekly income or their monthly cash flow, typically from their day job. It's what you do with that money that you take off the top. It's where you plant those seeds that you're going to reap the rewards down the road. And of course, that's where a lot of people have made a mistake, is they thought they planted those seeds and they put them into stocks, bonds, and mutual funds, and they just haven't produced the results that they're looking for in their retirement years. And I'm not here to badmouth stocks, bonds, and mutual funds, and I'm not to say that one's better than the other. I'm just looking at the historical performance as to how it's actually performed over the last 30 years to see what it's doing for retirees today. And I'm looking at what real estate has actually done for the retirees over the last 30 years. And more wealth has been created through real estate than any other form of real estate in the world. And so that's why we're here, and that's why our company is proud to present real estate investment opportunities for average Canadians to participate in. So it's really getting started with one house, turns into 2, turns into 4, and hopefully turns into many more. So you have lots of that monthly cash flow coming in years ahead, not to mention the capital appreciation for real estate capital growth. Our focus is really in the Arizona marketplace, and our market analysts tell us that in North America, if you were to invest anywhere right now in real estate, where should that be? First of all, they'll tell you that it's in the U.S. and specific markets. The second thing is they'll tell you those specific markets are Florida, Nevada, and Arizona are the top markets in the U.S. to invest in right now. And then they'll drill it down one step further for our guys and say Arizona is the best place to invest for a number of reasons. I'll talk about those through the course of this presentation. Us as Canadians, we see Arizona as a great place to be a snowbird, to go down on vacation, play some golf, maybe take in some great entertainment. And that's what we see. And we think of Arizona as being a snowbird kind of community, lots of retirees, which of course there's tons. But the reality is that Arizona is made up of everyday Americans that are working. The average age is 35.4 years old. They've got a younger, educated workforce there. Lots of major Fortune 500, 1,000 employers call Phoenix home, and we're going to share with that a little bit time here. But Phoenix is about the Valley of Phoenix is about 8,000 square miles and contains a population of about 4.5 million people. So it's definitely a vibrant community. We've got a great opportunity in Phoenix right now. The housing market there, you can buy a house right now that's about 50% of replacement cost, cash flowing assets, and the products in high demand. And we've got a great opportunity. So we call this an overcorrected market, and it's all in the back of the subprime mortgage crisis. The market has bottomed under $200,000. So if you're looking at our asset class, which is under $200,000, it's clearly identified that market has bottomed. Now, a house that's $1 million, I think there's still maybe a little bit of room there to fall, or it's definitely a buyer's market. But what's happened for single-family homes in Phoenix under $200,000? The complete reverse as to what it was 2 years ago. Now we're turning in to be a seller's market. We see price escalation happening month over month over the last Q4 and Q1 as well this year. And so it's definitely bottomed out and it started the recovery process. Of course, we've got a strong Canadian dollar. We're battling with par on a day-in, day-out basis. So we've got a great strength in the Canadian dollar, which bodes well if you're investing in the U.S. right now. We have low interest rates, both in Canada and the U.S. We have low interest rates for our mortgages, and that's a great thing. Strong and growing rental market because there's so many foreclosures there, and people that are there that are getting foreclosed on, they need a great place to live, and that's what our job is, to make sure we get some good housing for them to move into. So we've got a really strong rental market, and our historical performance of our portfolio proves that. Banks are not extending credit easily to owner-occupiers. It's there for them, but it's not easy for them to get. Typically, you need about a 700 beacon score. You need good job stability and good cash flow, which a lot of Americans do. It's just not as easy as it used to be, and that's probably not a bad thing. Arizona is a landlord state and is a pro-business state. So the laws in Arizona, that's one of the reasons why we're there versus, say, Florida or California, is that the laws favor the landlord in the state of Arizona. And that's a good thing. And there's all the reasons why that's a good thing, and we can go into that in a later presentation or a one-on-one consultation with your client care. But it's a landlord state, so that's a good thing. The other thing is there's a conservative government in place, and it's pro-business attitude. They favor business to move in there. There's a low corporate tax. There's no franchise tax, low sales tax, affordable housing, lots of land for development of businesses, and great lifestyle advantages as well. So this is all in the back of the financial crisis, also known as the subprime mortgage crisis. And basically we had an extremely hot market that cooled at the start of 2006. And the reason why it was hot is because the government, along with Wall Street and the banking industry, thought they'd come up with a mortgage that anybody could qualify for. And we always joked and said, if you can fog a mirror, congratulations, you got a loan. So can you imagine that mortgage product being available? Pretty much anybody could qualify, and you really didn't need a down payment for the house. I know it sounds odd for us Canadians to hear those words, but that's exactly what they created down there. And so can you imagine if everybody could get a loan? What do you think would happen to housing values if everybody could get a loan? Of course, housing values would go through the roof because there would be so much demand, not enough product, and prices would just run up like crazy. That's exactly what happened. And when some of these mortgages started to reset, and these mortgages were issued at, say, 2.5% because they were subprime mortgages, good for 3 years. When they reset, some went up to 6, 7%. So can you imagine your monthly mortgage payment tripling when it reset in 3 years? Well, guess what? That's exactly what happened. So in 2006, the mortgages that were issued in 2003 started to reset, and the people couldn't afford those payments anymore. Some people's payments went from $1,000 a month to $3,000 a month, and nor could they make those payments, nor could they sell their house because everybody was starting to put their house in the market when their mortgages reset because they couldn't afford the payment. So the complete reverse happened. That happened in the 2003 is that they started to put their house in the market by the thousands across the U.S. And thus you've got a subprime crisis where you have more supply now and not enough demand because the prices just heated up. And we had lots of toxic loans out there with 50-year amortizations, interest-only loans. They had loans that would include all your closing costs, so they had 105% loans, and just created an extreme surplus of inventory. And so the subsequent effect of that is lots of defaults. Some of the worst hit markets, of course, we know there's lots of opportunity in the U.S., but there's certain markets that really are probably the worst hit markets that we say are the best opportunistic markets where you can get the best value today, best cash-on-cash returns, and highest probability of appreciation in the near future. Florida, we all know, some great opportunity there. There is good opportunity there for Canadians as well, but it's not as great as other areas. And the reason why is Florida, an investment in Florida with a Canadian is you pay more in property tax for your foreign ownership. So your property taxes are about double than what they would be for a local Florida resident that they pay. In addition to that, your insurance is more money because of the hurricanes and tornadoes, and so you have more costs. When you have more costs in your property, you have additional expenses. Your return is going to be made between your income, which is your rental, and your expenses, which is your insurance, your property taxes, your maintenance costs, your property management, and at the end you're going to get your net return. Well, in Florida we're not getting as good as return as what we could get in some other markets, so Florida just didn't work for us. Nevada, I think there's a great opportunity in Nevada. However, we see some better opportunity in Arizona. Nevada doesn't work for us because it's not as fundamentally diverse as Arizona, but I think there's some great buys in Nevada. I think it's a good market. It's just if I had a choice to place capital with investors, I would choose Arizona because it's much more fundamentally diverse. And that means that we are going to have stronger fundamentals, which means we're going to have stronger job growth, stronger population growth, which means it's going to be a constant stream of people that want to rent my property, as well as it's going to put upward pressure on my appreciation. I think you'll see that in Nevada. It's just going to take longer to happen. California is simply out of the question. California's got major issues. First of all, it is a judicial state, so it takes longer for the foreclosures to get through the pipes, so it takes longer for us to get our hands on them for our investors. Second of all is the price of properties are too high. The cash-on-cash returns aren't anywhere near what we can get in Arizona. And the third thing is we feel there's upward pressure going to be on property taxes to bail out the huge deficit that the state has there. And it's a future hindrance that could happen and could really affect our performance of our investors' properties. So the worst hit markets: Florida, Nevada, California, Arizona. But Arizona wins for us based on their market research and all the intelligence and all the technical analysis that we put behind where to invest capital. And there's lots of reasons why, and I just named a few as far as why Arizona is a better market for our Canadian investors. Housing Affordability Index is extremely important that we look at that as an investor. As an investor, you want to own property where you can get positive cash flow first. It's very important you get positive cash flow. And second, an area where you're going to maybe see some good appreciation over the shortest period of time. And in order to make that happen, in a lot of cases, you need to make sure you've got affordability within your market. And so it's important that we're investing in markets that are considered affordable on the affordable index, where the average person can afford to get into a home. And when you look at Phoenix right now being ranked third in all of the U.S., bodes well. And of course, there's 2 Arizona cities on this chart. You see Tucson, which is just south of Phoenix, and then Phoenix itself. So from an affordability standpoint, it means that 83% of the people in Phoenix can actually afford to get into your rental property. So that's important, and it means 83% of the population can afford to rent your house. So it's a good thing. How long until the single-family home distress property returns to normal? That's a question that we get all the time. And based on our analysis and based on the amount of supply in the marketplace and the amount of foreclosures coming through the pipe and the shadow inventory that is in existence, and if you look at, so that's supply coming through, and if you look at the demand, and that would be what's the demand for the properties, we think honestly, if we looked at the 12-month average trend line and the 3-month average trend line, we think that we've got about 8 months to play this out at a low level of threshold for cost. So if we look at where we are today, we think today is probably the best time to buy that there's ever been. And the reason why is because prices are still rock bottom, and we are just about to lift off from the bottom and get back up into towards a normalized trend line. And so when I say 8 months and I say now's the best time to buy, it is the best time today, because if you wait 6 months, you're still going to get a great property. It's just not going to be at the same discounted price that you could get it at today. But to buy at a low level, I think you got about 8 months. But today and for the next 30, 60 days is the opportunistic time to get into the market. If we take a look at the market recovery analysis, this graph is a real good graph because it tells us exactly where are we today. But it also tells us where have we been and where do we think we're going to go for price appreciation in the future. So if we take a look at this white line here, this white bolded line, it kind of tells us where prices have been. And you can see if you look at the years from the early 90s and you go through till about 2003, this is what we call a normal market. Real estate historically over the last 30 years has appreciated about 4.5%, not including any leverage. So if you just bought a house, sat on it, every year your property would increase about 4 or 4.5%. And that's why so many people have created wealth through real estate, is because it's just a nice steady game. It's pretty predictable. It's not volatile like a stock. You just sink your money in there and it'll just grow over the course of time. But what happened here in 2003 with the creation of the subprime mortgage is it put so much pressure on the housing stock that there wasn't enough houses for all the demand. So can you imagine if you owned a house in Phoenix in 2004 and the price of your property was going up 5 to 10% a month? Could you imagine how that would make you feel? It would make you feel great, and it'd make you think that you're the king because you bought something that, of course, works, which is real estate. But your price of your property is going up at an accelerated rate every day. Well, of course, with so much demand, it put the pressure on prices, and prices just went through the roof because there wasn't enough houses to meet the demand. And why Phoenix? Phoenix is known as a strong market, strong fundamentals. So investors understand that, especially the wise investors understand that. But the wise investors, of course, they are going to buy here and sell here. That's what the smart investors would do. The not so smart investors would buy here, and that's the general public actually, and that's where a lot of people buy stocks too, is when they're already run up. So a lot of investors would buy in through here, and then maybe be trying to bail out down here. The complete opposite of what you should be able to do. So what happened is, of course, prices just went through the roof, and then when these mortgages started to reset in 2006, what happened? The subsequent downfall. Because there's just too many homes in the marketplace and they're going into foreclosure because the homeowners can no longer afford to make those monthly payments. Where we are right now is we're right here. That's where prices are right now on average. And this is an undervalued market. So where prices should be is prices should really be right here where the green line is, and this is what we call a normalized trend line. And this normalized trend line would be where prices should be based on our opinion if there was no boom, bust cycle. If things were just to continue along and chug along how they were, in the 90s and early 2000s, this is where prices would be. And why prices would be there is because it's a reflection of demand and construction costs. And so that's where prices need to be, is they need to be back here, especially in growth markets. It's magnified. Where are prices today? Prices today are down in this area through here. And so it's an over-corrected market because it's so far below replacement cost and where prices should be. What we feel is going to happen over the next 3 years, we feel that there's going to be an accelerated appreciation in real estate values as we go towards a normalized trend line as we get back to this market through here. There's going to be an accelerated appreciation. So, like I said, for people to step in now, great opportunity to step in, and as you can see, we've hit the bottom of the market. Now, if people want to wait, 6 months, a year, well, that's okay. I still think they're going to get a good deal because you're going to be buying in through this area through here, just not as good a deal as they could have got. And so the wise investors, the smart money, is buying here. Just like the smart money with the creation of the subprime mortgage, they said, oh, I'm going to buy a house now because prices are going to run. Lots of wise investors with the creation of the subprime mortgage bought here because they knew there was going to be a huge run-up. They bought here and sold here. That's what the wise investor did. And then they're selling to these guys at the peak. These guys here, whoever buys here, and we got tons and tons of people who are doing that with Arizona Investar, they're saying now I got to step in now because they understand the fundamentals. And these are experienced investors. And then they're going to ride that way back up. And a lot of our investors said, you know what, I'm just going to hang on to the property, and all this money I make in through here, it just goes right on my balance sheet, increases my net worth. And you know the other beauty about that is they can leverage that to the bank and pull money out, and they don't have to sell their asset because they've increased the value of the asset, and therefore to them that's money, and they can actually pull money out from the bank by remortgaging the properties. And the other thing is there's lots of demand for tenants as well. So this kind of tells us where's the market been, and where are we now, and where do we think that market's going to go to over the next 3 years. Arizona was one of the only 2 states to be in the top 5 growth states in terms of population and employment and personal income every decade since World War II. And so I think that statement is pretty powerful because it tells us that not only is today a good time to step into the Arizona real estate market, but when you're an investor, you want 2 things when you're a real estate investor, 2 primary things. You want population growth and you want job growth. You just don't want population growth and no job growth because then you won't have the GDP kick in and you won't have people really spending money and buying houses, buying cars, buying TVs, really boosting the economy, boosting the confidence, because when people are buying these goods and services, it means that the spill-off effect is that the people that are selling those goods and services can now afford to get in and buy houses, buy cars, and TVs. So it's just a whole rollover effect. So you want those 2 things. You want population growth as well as job growth. And one of the reasons why Arizona was a proven market by our analysts for Arizona Investar and our investors was because historically Arizona is one of the strongest growth and job growth states in all of the U.S. and quite frankly all of North America. And so that's one of the reasons why it's a very opportunistic state and a great opportunity to invest at the right time. We'll take a quick look at this slide. This is when we compare real estate to, say, buying stocks. And so let's just take a look at a few line items there when we compare common stock to real estate. And let's just take a look at some comparables here. Let's take a look at capital invested. So if somebody invested $100,000 in a common stock versus, say, $100,000 in real estate. Well, the nature of the asset you're investing into, when you invest into a stock, you'd be getting a stock certificate. So a lot of times you hear people refer to the stock market as a paper asset because you get a stock certificate. In real estate, it's true you get a hard titled asset. So you get title to the actual property that you own. So you actually own that house. You own those bricks. You own those cabinets. You own the plumbing, electrical. You own all that hard. The value of asset controlled, if you have a $100,000 stock, you typically would control $100,000 of stock. And typically you'd pay retail for it because that's the price today. In some cases, you can leverage that and get up to $200,000 in total value, but it's not real common for most investors that they can go to the bank and get leverage based on their stock. Now, with real estate, really, in a good lending environment, you can get up to $1 million in assets for your $100,000. Today, you'd probably get about $250,000, $300,000 to control on hard assets if you had $100,000 down on a house, but still 2 to 3 times the money that you have in cash. So that's a good thing. Your purchase price, typically with stock, you pay the market price. With real estate, you would typically, and today you could find and buy it at an under market price. As we showed you on the previous graph, prices should be higher than they are today. And that's what we talk about, found and bought it on a market price. You can do that with real estate with a well-timed purchase. Market efficiency, I think the market efficiency with stocks is supreme. Everybody pays the same price for a given stock. It's all the same. So when you talk about market efficiency with real estate is quite low, very opinion of sellers and appraisers, but sometimes that's where the actual opportunity is for the wise real estate investors. Potential for value improvement, stocks, absolutely none, unless you actually own the company. You really don't have any to up your value of your stock. You're relying upon somebody else to do something. With real estate, actually you can do something to improve the value. You can renovate your house. You can refurbish it. You can fix up the cabinets in the kitchen. You can redo the bathroom. You can upgrade the landscaping. When you do these types of things, it actually increases the value of your home. Some areas more than others. Instead of redoing the second bedroom, and maybe you're better off to put that money into redoing the cabinets in the kitchen or something along those lines. And the other good thing is that all those costs are 100% deductible and depreciable against your income. So that's another advantage with real estate. When can appreciation be? Typically with stock, you need to sell your stock to get money out of your stock. That's typically how it works. With real estate, you just do a refinance or what we call a re-leverage at any point. And when I talked about, when the price of your property increased in value, you can actually realize and pull that cash out by doing a refinance, and you take some of that money out so you can get some of that appreciation over there. The other thing is cash flow during the holding period with stocks, typically small dividends, and that's if you're lucky with the cash flow. Most stocks are growth stocks. The other thing with real estate is you get income from your rental. Because you have food, clothing, and shelter, it's one of your three essentials of life. Everybody needs a place to live, and if it's well bought, well selected, which is what the Arizona Investar program is about, you're going to have income coming from your rental, so you get some cash flow. Depreciation, 0 on a common stock, and with real estate you can depreciate it over the accounting life, which is about 27.5 years for your depreciation. The other thing is you get a little bit of inflation protection with real estate, whereas common stocks you get no inflation protection. And you get inflation protection with real estate with both rental income and the sale price are indexed to current market value. And I think this is pretty important for people to look at, especially with what's taking place in the world economies now. I think you're going to see a run-up in inflation over the next few years. So it's really important that you make sure that your dollar, your investable dollar, doesn't erode in value. And I think everybody knows if you look at how much it costs to buy a quart of milk today versus what it cost 20 years ago, it's a heck of a lot more money. Same thing with real estate. If you take a look at what it costs to buy a home 20 years ago versus today, it's a lot more money today. Well, that's inflation. But if you already own property that's an inflating asset, well, you'd be hedging inflation because you own the asset that actually increases in value, and that's what you want to do. So what you want to do if you've got money sitting around, put it into an inflating asset such as real estate, because if you left it in cash, let's face it, that your dollar will be eroded year over year over year as inflation takes place. So if you take that money out today and you actually put it into an asset that actually increases in value, it would work to your benefit. So it's an inflation protection with real estate or an inflation hedge. Return upon any sale, of course, that's just your actual stock value of the common stock. Return upon any sale with real estate, of course, is you can have compounding appreciation on your real estate where it's worth more and more every year. Sure, there might be some peaks and valleys and these types of things, but over the longer haul, real estate will always an appreciating asset because it'll inflate with the overall global inflation. You can do improvements with money and get value that way. Rental income, less your expenses, less your depreciation, and your tax deductions will give you some positive cash flow at the end of the day. So there's all these factors that go in to give you a return on your real estate. If you look at real estate versus, say, stocks and mutual funds, real estate over the years has always performed better than stocks and mutual funds, and we just went back to 2000 in this slide here, but educated investors are really starting to focus in on what works, and for a lot of people that's real estate, and we're getting a lot of attention to that asset class now. Just a few other reasons to consider Arizona. The first thing is it's a lien theory state, and what that means is it means that the houses going through foreclosure can actually move through the system a lot faster than if it was, say, a judicial state. Most provinces in Canada would be judicial provinces, meaning that if somebody goes into foreclosure, the courts are involved, and that'd be a judicial sale, the courts are involved in disposing of that asset and making sure that the interests of the homeowner and the lender are looked after. And it takes a little bit longer to go through that process, and there's some states in the U.S. that are judicial states. An example of that would be Florida. Florida's a judicial state. It takes about 200 days to a full year to get a house through the system. Arizona, it's a lien theory state, which means it's not a judicial state. It doesn't have to go through the courts in order for a lender to foreclose on the property. What the lender would do is they would issue their 3 notices to the borrower or the homeowner, and then if the borrower or homeowner does not pay and bring current the mortgage, they would retain a trustee, and the trustee would provide the homeowner notice that the house is going for sale, and the lender wants to realize on the security, which is the mortgage over the property, and that's a lien theory state, and takes about 120 to 150 days to go through the system. The other thing about Arizona right now is the shadow inventory is dissipating, so we're seeing less and less foreclosures in the marketplace, which is part of the signs that we're seeing for the recovery side here now. It's a non-deficiency state, so if an owner decides to walk away from their mortgage, the mortgage company cannot go after them personally or take their cars or any other assets that they have. All they can do is take the asset back and scar up their credit report, and that's what they can do. So that's called a non-deficiency state or non-recourse loans. All the economic indicators, both past and present, tell us that Arizona is a strong market for investing, specifically in the asset class of real estate, and at no time have we seen a better opportunity than today. And that's why Arizona Investar is assisting the Canadian investors to participate in this marketplace. Phoenix is a growth market, like I mentioned earlier, and here's just a graph that shows you the projected growth areas in the Valley of Phoenix going up to the year 2020. And as a matter of fact, the U.S. Census Bureau projects that by the year 2020, between now and 2020, Arizona will be the second highest growth state in all of the U.S. And so that bodes well for the state of Arizona. When you take a look at this map here, you can see there's lots of major companies here that you recognize these names here that call Phoenix home or have a major representation in that market. And again, we look at this here and we see some companies on here such as Walmart, Banner Health, Wells Fargo, Honeywell, Motorola, U.S. Airways, Arizona State University, Banner Health, Amcor Technology, Insight Enterprises, Swift Transportation, all big companies that call Phoenix home. So what it means for us as a real estate investor, it means that the market is very fundamentally diverse from its employment makeup. And when we compare that, say, to Nevada, even though I think Nevada's a good market, it's just not as good as Arizona, but I'll compare it to Nevada. Nevada's main drivers, as we know, is gaming, tourism, hospitality, conventions, distribution. And so it's just not as fundamentally diverse as, say, Arizona. And the reason why that's important to an investor is because, say that the airways economy goes sideways. Say that the federal government imposes a 20% tax on all airline tickets, and therefore would reduce the amount of people traveling with airlines. It would have an effect on their business. They'd have to lay people off, and it'd be a negative. Well, because Arizona is so fundamentally diverse from its employment makeup, it wouldn't kill the state or the city economy because it is so economically diverse. Now take it in reverse. Say in Nevada, say that the federal government said we're going to put a 30% tax on gaming. Do you think that would have an impact on the amount of people that go to Vegas and do gaming? Absolutely would, because it would increase their cost to go there and do what they love to do. So less people would go there. That means people would get laid off. That means that the buildings would be up for sale. They'd be downsizing, and it'd be a negative form. And because gaming is such a huge part of the Nevada economic profile, it would have a major impact on their employees, and employees would be leaving the state and going somewhere else where they could get jobs because it's not so fundamentally diverse. So again, Arizona being so fundamentally diverse, another reason why we are in Arizona and so many Canadians are investing there with us right now. Here's just a quick graph that again shows you some of the major Fortune 500 and 1,000 employers in the greater Phoenix market. Again, there's just some big names on here and really supports what we're talking about, it being very diverse. If we look at the Arizona employment growth distribution, we know Arizona is growing by population and job growth. Where are they going? So based on the Department of Commerce, we can see exactly where they're going. Most of the population is going to the Phoenix area. So 74% of the employment in Arizona is going right to the Phoenix area. And we talk about Phoenix. Phoenix is a city, but it forms part of the cities in the valley. So the other cities in the valley are things like Scottsdale, Chandler, and Gilbert, Avondale, Glendale, Peoria, things like that. That all forms the cities that form the valley. And quite frankly, you'd go from one city to the next and you wouldn't even know really you changed cities, other than maybe the houses might look a little bit different. Here's a map of the Valley of Phoenix right here. So this is the Valley of Phoenix that my cursor is going around here. And we're only buying into certain pockets of the Valley of Phoenix. We've done a lot of research, both from a rental standpoint, also from an appreciating standpoint, to understand where are the cities in the Valley of Phoenix to deploy capital for residential homes. And our research tells us it is specific zip codes in these cities. On the west side, Glendale, Tolson, Avondale, Peoria, northern part of Phoenix. On the East Valley, Mesa, Gilbert, Chandler, Queen Creek, Santan. Those are the areas to deploy capital, both from an affordability perspective, because you're getting affordable houses there, which would appease the masses. So you like that from a rental perspective. The other side is that those homes and those asset classes will have the most amount of appreciation over the shortest period of time. And so we like those. And we've got a lot of data that supports our thesis here. And of course, being an Arizona investor, you get to piggyback from all the research we did and enjoy the benefits both today and tomorrow. Also, this map, when you look at it, you also see there's a great infrastructure here with its transportation system. And so even though it's 8,000 square miles and 4.5 million people, traffic actually moves pretty good. And I know that when you land in the airport here and I'm heading over to the office in Gilbert, even though it might look like quite a ways away, it actually only takes me probably about 25 minutes to get there. And all I do is I land in the airport, I jump on the 60, head right down Elmo School, takes me right into the office. So it's pretty good. The reason why is because with the freeway system they've got here, transportation moves real quick. The other thing I'll tell you is that they also plan for the future. And let me give you an example of that. Over here, this is areas that are being developed now, or will be developed when prices go back up to replacement cost. But they've already built the 303. And the 303 takes you off the 17. This would take you up to Anthem and take you to Flagstaff. So this is north. So this is heading north out of Phoenix. Well, the 303 is they've done this leg over here, and all this is going to be future residential and commercial development through here in years to come. Well, they've already built the road because they know that the people will be coming down there. So they build the infrastructure first, and then the development follows, and they have the ability to do that, and not many cities do. So it's planned very well. Both the road structure system and the servicing system in Phoenix. There are 6 main financial benefits to investing in real estate for our investors. The first one, of course, is cash flow. If you get cash flow to a property, you should buy as many as you can, because I know here in Canada, in most markets, you can't get them to cash flow with 50% leverage. You can't get them to cash flow, not to mention 65 to 70. So cash flow is very important. The next thing is tax advantages. There's lots of tax advantages with real estate that you can't get with any other form of investment. Third thing, forced appreciation. We'll talk about that. Market appreciation, just general market appreciation over the course of time. That's a great thing you get with real estate. Principal pay down. As tenants pay you their rent, you pay your loan. If you got a loan in your property, every month can be chipping away at your principal pay down. And then, of course, last but not least, pull money out of your appreciating asset and enjoy it, or reinvest it, and we call that refinance. So we'll talk about those. The first thing is cash flow. Your rental income less your expenses. So an example would be you own a property that cash flows $1,200 a month. Your expenses for property management, property taxes, maintenance, HOA fees, say $237. Your net operating income would be $963. That'd be $1,200 less your $237 would be $963. Take off your debt. If you put on financing on there, and this is based on the debt you can get there today from U.S. banks, that'd be $488 per month, leaving you a net cash flow of $475 a month. So we talk about positive cash flow. Here's a prime example on a real property today that we have available that you would get net cash flow of $475 a month. And that's with cash flow from day one, tenant already in place. Talk a little bit about property depreciation, which is not something that a lot of investors know about, but they sure like it at tax time when their accountant says, hey, listen, because of your depreciation, you don't have to pay any taxes here. We love that as a real estate investor. And so I've always said depreciation is like your phantom tax deduction. And because your rental property is used but not consumed as part of doing a business, you can deduct a portion of its cost over each year of its useful life. And according to the IRS, your rental property has an expected lifespan of 27.5 years, which means that you can claim an expense of 127.5 of the cost of building improvements each year. So basically what happens is the IRS and Revenue Canada and most countries in the world allow depreciation. In the U.S., it's mandatory that you take it. So basically, at the end of the day, say that in your property you made $5,000 net income at the end of the year on your property. And because of depreciation, because the government says, well, your house is actually devaluing because it's older, so they allow you to reduce the value on paper, and that's called depreciation. So in this case here, let's say you could reduce your value by $5,000. Well, that $5,000 in depreciation wipes out the $5,000 in net profit that you had. So guess how much tax you pay at the end of the year? Zero, because your depreciation took it down. Now, as the life of your property goes on and as you charge more and more for rent, you're going to have to probably start paying some tax. But for the first 27.5 years, you can start to depreciate that down. The other thing about tax advantage with real estate, specifically in the U.S., is they have what's called the 1031 exchange, or a like-kind exchange. And here's what they allow you to do. And we don't know about this in Canada because we don't have this in Canada, but you can in the U.S. if you own your property in a corporation or a limited partnership. The first thing is if you have a property that's worth $100,000 and you bought it today, and you decide to sell that in 5 years and it's worth $130,000, well, essentially you would have a $30,000 capital gain. But if you entered in your contract to an intermediary, which is a transfer agent that does the 1031 exchanges, and you say, I want to put my property and my contract into an exchange because I'm going to buy another residential property. It doesn't have to be a single-family home. It could be a duplex, fourplex, multifamily building, anything to do with the real estate investing side. Can't be a personal residence. You are allowed to defer the tax on that capital gain, pay no tax on it, and roll that whole $130,000 or your profit into your next property and pay no taxes. So that's called a 1031 exchange, and it's a beautiful program that they allow U.S. corporations to take advantage of. General market appreciation, over the last 30 years, real estate has appreciated about 4.2% unlevered over the last 30 years, and that's including the boom bust cycles. So obviously it's a good performer. It's got a good track record. Well-selected real estate and well-timed markets can produce just a great opportunity. We call that accelerated appreciation. So let me give you an example. If you bought a house today in Phoenix, and we know Phoenix is far undervalued, and we know that there's going to be a forced appreciation as we quickly get back up to where prices should be, we call that accelerated appreciation. And here's exactly how it works on properties we have right now in our portfolio. Say the normalized trend line for prices for a house, we'll use our house at Oregon. Say the normalized price for that house should be just over $174,000. Because of the financial crisis and what's going on, we have a discounted, overcorrected market price for our investor at $103,000. Well, your market timing advantage is just over $71,000. So what that means, it means that your net worth is going to increase by just over $71,000, and there'll be no tax payable until you sell it. So even though you can use that money, like you can refinance it, pull money out, you can use it on your balance sheet. So you say I have an asset that's worth $174,000 that I paid $103,000 for. Well, your balance sheet just went up by $71,000. That goes right to your bottom line. So you're $71,000 richer than you were. And that's the power of real estate, and that's the power of buying well-timed and well-selected real estate. The other thing is forced appreciation. So we talked earlier in the presentation about doing things to your house to increase its value. So if you bought a house and it was kind of a rundown house and needed flooring and cabinets and paint, maybe a little bit of drywall work and maybe a few other touch-ups on the outside of your house, well, if you do work to the house, you'll actually increase its value. So if you replace the flooring, do the cabinets, do the paint, the house is newer, it's brighter, it's fresher, guess what? It's worth more money. Why is it worth more money? Because you put money into it, but somebody's willing to pay you more money because you put that money into it. We call that forced appreciation. You can do the same thing if you spruce up the exteriors of the house. If you have a house that's got siding that's falling off, or it's discolored because of the the blotching from the sun, maybe it's got some cracks in it. Your garage door's got cracks in it, and it's not looking as good. Well, when you fix those up, when you reside your house, you fix your garage door, you fix your landscaping up, it becomes worth more money. The other thing is change of use. If I have an old house that's on a corner lot on a main street on two main corners, maybe the better use for that property would be as a commercial use for maybe a convenience store and a gas bar. Your property might be more worth as a commercial use than a residential use, and we've seen people, our investors, make money doing that as well. So that's forced appreciation. Refinance. So let's give an example of refinancing your property. You bought a house today for $100,000 in Phoenix. In year 2015, it's worth $150,000. Well, your purchase price was $100,000. You put $35,000 down and you put on a $65,000 mortgage. You did that today. In 2015, say your house was worth $150,000, your new mortgage you could pull would be $97,500 versus say the financing that you had there is $65,000. You put on a new mortgage, we call that a refi of $97,500. Guess what you're going to do? You're going to pull out $32,500 in cash. You can help your kids go to college. You can buy a vacation home somewhere in a resort destination, maybe Phoenix. Or how about you maybe buy another investment property? And that's what we see a lot of our investors doing, is just buying more and more properties, just magnifying. And we call that velocity. The more times you do the same thing over and over and over again, you call that velocity. It really helps increase your cash flow and your net worth at the end of the day. So you can pull out $32,500, do with it as you wish. No tax payable in the month you pulled out because you financed it on your house. You can do this every 3 to 5 years in an appreciating market, and it's a strategy you utilize to acquire more properties. Principal paydown. And principal paydown is, I think a lot of you know how it works, but you know, if you bought a house in 2012 and you hung on to it for 10 years with current lending terms and rates, and say that your initial mortgage amount was $76,000, your tenants over that course of time paying current market rents and then using inflation for the next 9 years, your rent that they're going to pay you is just over $151,000. At the end of 10 years, your mortgage is $65,972. The amount that you paid down on your principal, or should we say your tenant paid down for you, love those tenants, $10,028, that's the principal pay down. They just paid that off your mortgage for you. And so automatically your mortgage gets reduced, and then it's your option whether or not you want to refinance and pull some cash out and pull it back up, which a lot of investors do. But again, it's the power of real estate that you can use that to your advantage. How our properties produce income and create wealth for our investors? I think the first thing is our market research and due diligence that we do, which we do, I think we do a great job at, and really analyze where exactly should we be placing capital today to maximize our cash flow and appreciation. We have a team of industry professionals we work with both inside our offices and outside as consultants. We have a system track that really walks our investors through an entire turnkey system that we call the Investor Turnkey Model, where you can know nothing about real estate other than I think it's a great time to step in based on the education you've got from Arizona Investar. We'll walk you through the entire process start to finish. And we know that you're busy doing your day jobs and things you've got with your family and your time commitments. This is what we do for investors, is we get them into real estate investing in a full turnkey model. So we actually take a lot of the work away from it for investors, and so they can actually enjoy the passive income that they get with real estate. Property performance, obviously, first and foremost, very important that our properties perform, and we've got a big portfolio down there that's been running for a while now, and of course, with all the years that the founders have in the business, it's definitely the performance is there. Investor growth portfolio goes without saying. Over the course of time, your portfolio is going to increase in value, your cash flow, and you'll see some nice returns. Let's take a quick look at the cash flow model. Gross scheduled income. So that's our gross income we get on a monthly basis minus our vacancy and uncollected rents equals our effective rental income plus other income if we have other income coming in from, say, we rent out the garage, maybe a basement suite, maybe income coming in from a washer and dryer. That equals our gross operating income. We take off our annual operating expenses, such as our property management, our taxes, our insurance, HOA fees, things like that. Take that off, you get your net operating income, and then you take off your annual debt service, such as your mortgage payment to the bank, gives you your before-tax cash flow. So this is our income model. And let's take a look at this property we've got right now in inventory today. It's available for Arizona Investor today. This one, we're just doing the remodel on this one. We should have that available to the public by Friday. This particular home is in the northern part of Phoenix, built in 2000. As you can see, it's a bungalow, just over 1,600 square feet. It's 4 bedrooms, 2 bath, 2-car front attached garage. The peak price in this house, it sold for $230,000. Replacement cost of this house is $205,000. The normal market value based on today should be $174,335 if everything was normal. The Investar price for this house, $99,950. The mortgage you could put on this house would be $64,968, meaning you need a down payment of $34,982. So if you're interested in this property, talk to our client care, and they can kind of give you some more information on it. But this one won't last because it's under $100,000, and it's in a great area, great rental area as well. And so please feel free to talk to client care about that. This particular home, let's use annual income, $11,400. Take off the expenses, the mortgage payments, you got positive cash flow, just over $4,000. Your 10-year positive cash flow projection on this one is just over $60,000 in cash flow over 10 years. The appreciation on this house, we anticipate over the next 10 years to see about a $42,000 price lift on this property over 10 years, and I think that's a conservative number. Your principal reduction would be about $8,600 on this property, and that's with the tenants paying your mortgage. So again, utilizing the power of all of the things that are great in real estate that we talked about. At the end of the day, if you look at the purchase price of this property and you look at the net positive cash flow, the appreciation, the principal reduction, and the total pre-tax gain of $110,000, $943, take off your original cash invested of $34,982, you're looking at a pretty healthy return on investments. Now, I want to say that when I use these forward-looking statements, they're based on our projections, based on how our historical performance has been. Now, that is no guarantee to an investor. That's exactly how it's going to work. So we always need to make sure that when we're providing these investment opportunities to our investors, we're compliant in the way that we do that. Now, we're here to walk you all the way through the process and work with you with your investment, but we can't be held accountable to the numbers that we're talking about, especially when we talk about future projections. We just based that on our historical performance. This spreadsheet here, I'm not going to go through it in detail with you, but these are the types of plans that we put in place for our investors that want to buy multiple properties. So we have lots of investors that want to buy more than one house. They want to buy 5, 10, 15, 20, 30 properties. And we walk them through a model where they can actually start today, and we can walk them through the stages they need to go through to buy multiple properties. And we see more and more investors going this way. Just a great way to increase your cash flow and increase your equity growth through appreciation, not to mention take advantage of all the tax advantages and other little perks that are available for investing in real estate. But this is a prime example as to how people are multiplying their purchases and taking full advantage of the opportunities. If we take a look at investing and just getting a cash-on-cash return, so I invested $100,000, I have $10,000 a year net cash flow. That means I get a 10% cash-on-cash return on my money. You can see what that does in year 1, year 2, year 4, year 8, and year 10. Obviously increases over the course of time because you're getting more and more rent for your property. Sure, your expenses are going up, but not at the same level that your rent's going up. If you take that cash-on-cash return and you also take into consideration principal pay down, I got somebody paying off my mortgage for me, well, you can see in year 1, a little bit more return than you got just strictly on cash, because as you're paying down the mortgage, you've got money you can use. So that adds that to your balance sheet. You can see what happens in year 2 versus say year 2 is strictly cash-on-cash return. Overall, cash-on-cash return and principal pay down, you're a little bit further ahead. And when you take cash-on-cash return, principal pay down, and appreciation, all of the things that you're going to get when you buy your property in Arizona, you're going to get all of these things. So all of these factors, all three combined, are to be taken into consideration when you're analyzing your investment, and your client care consultant will help you do that with Arizona Investar, and you can see it just really magnifies your return when you take into consideration not just, of course, cash-on-cash return, but principal pay down as well as appreciation. So how to buy an investment home with Arizona Investar, how do you get going? The first thing would be register with our client care division, and they'll be more than happy to help you out, introduce you to our product, give you all the education that you need prior to you making a decision, and then, of course, walk you through the entire steps that we go through with our full turnkey system. Discuss investment objectives. They'll walk you through your financing. If you require financing to buy your first property, they'll walk you through that process. They'll also walk you through the foreign tax consultation with our tax consulting, making sure that you're going to hold the title in the proper name. They'll help you select a property that meets your objectives, and then, of course, you'll close on the property, and then hopefully repeat the process. Excuse me. Right now we have an exclusive webinar offer for you. If you call right away and you activate this and you talk to our client care department and say, listen, I was just on the real estate cash flow webinar with Travis. I want to participate in this program right now. We have a special opportunity for you right now. And you can do that right now with this property we've got that we just acquired on Globe. And the purchase price of this house is $117,000. The peak price on this one was $295,000. It's in northern part of Phoenix, 4-bedroom, 2.5 bath, just over 2,000 square feet. The price, $54 a square foot. Replacement cost is over $100 a square foot. So again, we talk about 50% of replacement cost. This is what we're talking about, $54 a square foot. Monthly income coming out of this one is just over $1,000 a month. It was built in 2006, so it's only 6 years old. And what we're offering with this property is, if you step up today, is no property management for the first year. So we're going to cover that for you and cover the property management for the first year. So if you call client care and say, listen, I saw the webinar with Travis on cash flow, I want to take advantage of that deal you talked about, and you can do that. And it doesn't have to be on this Bow property, although I think this is a great asset for you to consider. Any of our properties we currently have available right now, this would work for. So give them a call, and they'd be more than happy to walk you through the program and get you started, whether that be with financing, your foreign tax consultation, or just general education. And I think it's important that you take that step. We put on webinars on a regular basis to walk people through. We also do Arizona foreclosure tours once a month, where you can actually come down, meet the ground team, and see the properties and meet the guys that make it happen day in, day out. And they're really proud of what they do down there day in, day out, and rightly so, because they're working hard and producing some good results for our investors. So you're more than welcome to come down on a tour that we do once a month, or you can for sure sign up for any of our webinars that we produce. We usually do 1 to 2 webinars per week, and once a month we provide market statistics on exactly what is going on. When you sign up with us, you'll also get our deal of the week. And so what we do is we produce a deal of the week. It's always our feature home of the week, and it's usually one of the properties we've just recently acquired, or one of our properties that's just coming out of being renovated, and we call that rent ready work. And so get connected with us. Go online, register. You're going to get lots of great information from our team, and make sure that you're fully educated on what's happening in the marketplace there. If you have any questions, feel free to connect with us at 1-855-456-3223, or go to info@arizonainvestar.com, and you can get lots of information there from our team. So again, for myself, Travis Cabin, and all of us at Arizona Investar, I want to thank everybody for coming on the webinar today. Out of respect to time, because we're running a little bit long on time for this webinar, I see a few questions that have come in. We're going to respond to those directly via phone call from our client care department and investor relations. We're going to call you investors directly or email you to make sure you get your answers, and I see quite a few came in. But again, just out of respect of everybody's time, I don't want to go longer than I said I would, and I think I am a bit longer. So just out of respect for that, I'd like to end it here for everybody. And but again, we think it's just an unbelievable, unprecedented opportunity that we've got right now, and with our entire program, our team, and the fundamentals that are in place in Arizona. So again, on behalf of all of us at Arizona Investor, I want to thank you for joining us today on this webinar, and we look forward to connecting with you real soon. Thanks a lot, everybody.